Unrivaled Nation, happy holidays. In this video, we're going to talk about two bellwether stocks for the US and global economy. We're talking about Nike and FedEx. What can it possibly mean for your portfolio? Talking about an overview of their latest earnings results, what it implies for the global economy. If this is your first time tuning in, you're watching Unrivaled Investing, please make a point of hitting that thumbs up, hit that subscribe button. So when we dive into Nike's results, you see that recently, just this past week, both Nike and Foot Locker shares sunk after the athletic apparel maker, this is talking about Nike, cut its revenue outlook, announcing billions of dollars in cost cuts. And when I dive into their results using AI Ticker Chat, first month is free, asking it to analyze their earnings transcript, say, hey, why might the stock be lower on this? What are the Wall Street analyst chief concerns based on this call? Getting a quick summary, it's about a revised lower outlook, increased macro headwinds, particularly in Greater China and EMEA, Europe, Middle East and Africa, softness in digital traffic. They're expecting third quarter to be negative sales. So that's their upcoming third quarter results because it's slightly different than calendar year. They're also talking about how for the full year, they're now expecting only 1% growth. And I'm going to talk about in just a second why that's a problem, seeing traffic softness and higher marketplace promotions. So that means increasing competition. So this is the broad weakness that you're seeing with Nike. The reason why it's a particular problem is you're looking at a stock that for years has traded around 30 times earnings, still trading around 30 times earnings. And that's a challenge when you're only guiding to, let's say, 1% growth and guiding to a decline in the next quarter. And then you look at competitors, emerging competitors like On Holdings, ON. This is a premium performance sportswear brand. And you can see the summary of their latest earnings results talking about how they're growing 46%. So this is a red flag for me personally when I'm looking at any company. There's different types of analysis you do as an investor. You want to make sure the business is healthy. That's analyzing the balance sheet. Does it have enough cash flow? You also want to understand its competitive positioning. And one way to do that is to assess the brand. And that's a qualitative assessment. Another way is a quantitative assessment saying, hey, are you growing and are you taking market share? When Nike's saying, hey, we expect to decline or we're only going to grow 1% this year, and we see heightened promotional activity, and you see a new emerging brand grow nearly 50% a year, it's a red flag. It's a red flag that your competitive positioning might be getting eroded. So I'd want to learn more about that if I were a Nike shareholder. I'd also want to learn more about On Holdings. Say, is this a upstart that could disrupt, a legacy brand like Nike? Now, keep in mind, Nike's more than just shoes, but it's a huge component of their business. If we look at another bellwether, we're talking about FedEx stock. It also tumbled 12% this week as their results fell short of estimates. They also talk about weaker outlook for the year. When we actually look at what happened, management talks about, oh yeah, we have different types of business. We have, lower price FedEx Ground, and then we also have FedEx Express. You want to get something expedited, and you're going to pay for that. Well, when you're paying for the expedited shipping, that saw a more significant decline, 6% decline year over year, versus the lower cost ground shipping was positive 3%, FedEx Freight down 4%. So looking at this picture, you're seeing a weakness in the premium offerings where people saying, you know what, it's okay, it can wait. And that is a tell on the global economy where you don't need to ship things, as speedily, saying, yeah, it could wait a couple of days. We don't need to make sure it gets there tomorrow. Maybe there's inventory built up, and you don't need to send it as fast. Looking at the monthly trends, also not painting really a healthy picture. And this has been going on for a couple of months now, where FedEx Express has been negative for several months now. And you could see, international is the only sort of spotlight that was meaningfully positive. You're looking at freight down as well, ground break even, 0% in November. So broadly looking at challenges in the volume trends at FedEx, I think that is an important signal that this is not a particularly hot economy. When I think about the valuation, so, Nike was trading at 30 times for 1% growth. FedEx is effectively 1% growth as well. You could say, you could say it's not really growing at all, and so I plug it into AI Ticker Chat to get a range, of how does it perform in the years ahead. And it's effectively assuming, okay, maybe these continued, softness continues. of, down 2% per year for the next few years. Maybe it's 2% growth. So very flat results, but maybe you're able to get some sort of managing their costs, and you get some margin improvement, and maybe the multiple expands. It goes from 15 times to 22 times. If you get some sort of multiple expansion and margin improvement with barely any growth, you could have an attractive return, over 100% upside over the next 5 years. So this is a more interesting development because unlike Nike, where it's 30 times earnings and negligible growth, FedEx is half that valuation. And so if you're able to get any sort of tweak in terms of growth, getting higher, or some sort of valuation expansion, that is a huge difference that you could potentially get with something like FedEx, where you can get some sort of valuation tailwind, a benefit for them if, they're able to post some growth or post some earnings, improvements. So I'm looking at this, and I'd say FedEx is more interesting, not deeply compelling, but certainly more interesting, especially because when you compare it to Wall Street analysts are even more optimistic about the growth profile than what AI Ticker Chat is predicting. AI Ticker Chat saying in the high case 2% growth, that's lower than the analyst lows on Wall Street. So that would suggest, hey, there could be even more upside here. So this, if you wanted to explore these types of companies, I would say this is, when I say these types of companies, lower growth, potentially lower multiple companies, I would say this is, something to learn more about when you're trading at 15 times earnings and it's clearly not pricing in what Wall Street is expecting in the next few years. So it's interesting, I would say. Now, what are my personal thoughts on the stock market, or what does this imply for investing in general? Because I think there's some super important lessons for investors to consider. First of all, in full disclosure, this is not financial advice. Also, quick plug, take charge of your investment journey with unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. That's once again Unrivaled Investing. The rate for the premium subscription is going up within the next few days. So when I think about this, the key lessons that I think investors should consider is, first, is that you can go to my very first video here on this channel, which is that the framework for thinking about your potential returns as an investment, whether or not it's an unprofitable company, whether or not it's a legacy institution like Nike or FedEx. No matter how you're looking at this, it always comes down to three key things that drive your return. Even if you have a dramatic Santa rally and everyone's excited, even if you're in a recession and everyone's saying, oh, things are terrible, it always comes back down to those three key things, which is, you're talking about the fundamentals. What's the fundamental core growth in this business? Do you have some sort of free cash flow that's going to drive and grow this business? How do you think about the growth? Growth is the key, and that's what drives most of investor returns over time. So thinking about growth. The next thing is, what's the valuation? And when I see Nike trading at 30 times, I'm thinking that creates a headwind for shareholders for years to come, unless they can figure out some magical way to reinvigorate that brand and really accelerate growth. Otherwise, you can have a situation where it resets back down to 20 or 15 times in the future, and that's a multi-year headwind for Nike shareholders. So that is something for investors to consider. So you have the core growth, do you see revenue growth? Do you see profit growth over time? Then you have valuation. And sometimes you have these two things wipe each other out, where you can say, hey, earnings doubled over 10 years, but the valuation got cut. In which case, you're seeing a much weaker return over that time period. Then the third component is the free cash flow then you can get to you as shareholders. So it's important to consider each of these variables, but when you're looking at companies where they're saying, hey, maybe we get 1% growth this next year, it's super important for you to be mindful of the valuations. And that's, I think, one of the bigger concerns I have when I look at the market in general is, markets trading 20 times plus earnings. I'm seeing more and more companies like the Nikes of the world where I'm going, I just don't get it. Why would I want to pay 30 times earnings for a company that's not posting incredible growth? Maybe you get that free cash flow as some sort of dividend buyback, but I'm not seeing that three-pronged component where I can pencil out really compelling 15 to 20% returns. So when I see these types of situations, I go, that's just too hard for me personally. Now, I think it is important to recognize you can still have attractive returns in lower growth situations, but it needs to be offset by valuation and the cash flow to shareholders. And historically, FedEx, they've had to reinvest a lot into the business because it's a capital intensive business. So these are the challenges that you need to consider. You can find something that maybe it only grows 0 to 5% per year, but if they're trading at, let's say, 5 to 10 times earnings, that can be a very compelling situation as well. If they're, let's say, able to buy back lots of stock and you're able to see it in a return to you. But I'm looking at this broadly, and maybe FedEx is more compelling than Nike, I would say, certainly given that it trades at half the valuation. But I'm looking for things that have even more upside potential. And as stocks rally or broadly higher over the last few weeks and months, without really seeing the fundamentals back it up, it does make me a bit cautious. And so I think that is important for investors to consider, and also for you to reflect on your own holdings, is how does these three key components, the growth, the valuation, and free cash flow that can get returned to you as a shareholder, going to drive your returns over time. If you have, a thought or comment that you'd like to leave below, I'd love to hear it, and I'll read it in, if you post it. And happy holidays, everyone.